And it looks like the next Keynesian style recession is on the way. We're seeing it on the low end, we're seeing it on the high end, we're seeing it in employment. And the new unemployment numbers are going to come out in the next few hours, but I got to record this now. So the unemployment rate is probably going to be up. We are within months of the next official recession, which will probably turn into a big depression, and then we'll have the last round of money printing. How I see it going down is that the numbers, the Keynesian style numbers that tell us that the economy is either inflated or deflated, well, they will get worse and worse. And then at some point, at the depths of it, the monetary plumbing is going to clog, and that is going to signal the final printing round, what I think will be the final printing round. We'll get into those numbers in the slides. We are months away, I believe. I have said that before. I said that months ago, but we're still months away. But I'll let you decide how far we are once you see the evidence that is presented here. So once again, we see it on the edges, in the illiquid parts of the economy, in the marginal parts of the economy, and then it will come into the center, into the plumbing of the monetary system, and from there will be an implosion or explosion or whatever implosion you want to define, and we will head into the final round of monetary inflation, which will bring gold and silver up to who knows what.
In today's news recap, silver price consolidates below $29 ahead of NFP. Silver oscillates in a narrow trading band during the Asian session on Friday and remains below the weekly top touched the previous day. Traders now seem reluctant and prefer to wait for the release of the crucial U.S. non-farm payrolls report before pacing fresh directional bets. Looking at the broader picture, the overnight failure to find acceptance above the $29 or the 100-period simple moving average on the 4-hour chart warrants some caution for bullish traders. Moreover, neutral oscillators on the daily chart make it prudent to wait for a sustained strength beyond the said handle before positioning for an extension of the recent bounce from the 27 and 70 area or a nearly 3-week low set on Tuesday. The subsequent move up has the potential to lift the white metal further towards the intermediate hurdle, en route to the $30 psychological mark. Some follow through, buying beyond the August monthly swing high will be seen as a fresh trigger for bulls and pave the way for a further appreciating move. The silver price might then climb to the horizontal resistance before aiming to reclaim the $31 round figure mark. On the flip side, immediate support is pegged near the 28 and 50 region, below which the commodity could accelerate the slide towards the $28 mark. This is followed by the weekly trough around the $27.70 zone. A convincing break below the latter might prompt aggressive technical selling and drag the silver price to the 27 and 20 intermediate support. Now we'll show you the best clips of the latest interview, but first hit the like button, smash the subscribe button, and turn on notifications so you do not miss out our daily recaps. Enjoy the episode.
People often ask, why aren't diamonds money? Well, because they are not liquid. They are not liquid, therefore their price changes very quickly relative to other things, and they cannot be a good money. They are not very divisible, and if you divide them, they lose their value. But here we can see in a graphic sense, very graphic, why diamonds are not money. Diamonds are at their lowest price since 2002. This chart is from Zero Hedge, taken from the Diamond DSTD Index, and or I think it's called the IDEX or whatever it's called. We can see here what happened to diamond prices in the 2008 recession. They went from about an index of what was that, 6,600 to 4,800 maybe, but now we're even below that. We're at 3,620. Diamond prices are below what they were at the peak of the 2008 great financial crisis. That means that people are really cash strapped. It does not look good for the high end of the economy. And if you were to take this chart in terms of the price of gold, diamonds in terms of real money, it is so much lower down than it was in 2002 that I can't even really calculate it because, in 2002, gold was what, $300, and now it's $2,500. And in nominal terms, even in dollar terms, the price of diamonds are below what they were in 2002. So imagine in terms of the price of gold, that's why diamonds are not money. If you invested in diamonds in 2002, you're down. Even nominally, if you invested in gold, you're up about by an order of magnitude. So there you can see diamonds are not money, gold is money, and silver is money. We just talked about the high end of the economy in diamonds. Here's the low end of the economy in Dollar Tree. Dollar Tree really has got to change its business model to ounce tree or gram tree in terms of silver or gold grams. Well, gram tree. If it was in terms of grams, then its price could stabilize. But since they are in terms of dollars, you can see the incredible volatility here in the low end of the economy, in the Dollar Trees and Dollar Generals. They've lost all gains since the 2020 lockdowns. They lost all of it. We're back down to the 2020 lockdown low, which happened to be the 2015 low, which happened to be the 2013 high. Is it going to break? Are we going to have support here? I don't know. But the point I'm trying to make here is that the low end of the economy is crashing. The high end of the economy is crashing. We are headed for the final Keynesian style recession, which will turn into a depression, which will lead to the final round of inflation, of monetary inflation, which will slingshot real money. Let's go to the next slide here. This is related to the reverse repos, which are down back below $300 billion yesterday to, I think, $291 billion. So here, what you can see is that I copied this from SIFMA. That's that organization that puts crunches the numbers for all the treasuries that are issued in the previous month. So here we have August 2024. There were $206 billion. You can see that in the lower right-hand corner here, $206 billion of net bill issuance. Why is bill issuance crucial? Because net bill issuance is what sucks out money from the reverse repos, from that final spare dollar tank that was created in 2021. Money moves from there into bills. The bills are sold for dollars that go to the Treasury's account, which spends it on welfare and warfare mostly, and empties out the reverse repo tank. You can see that the net issuance for 2024 has been $446 billion. And if we go to the next slide, you can see that the net drainage of the reverse repos in 2024, remember, $446 billion, and the net drainage has been $403 billion so far for 2024. We started 2024 at $705 billion in the reverse repos. We are now at $291 billion in reverse repos. The difference is $403 billion, very similar to the net bill issuance. You can see that the bills, the dollars, come from the reverse repos, go into the Treasury's account. So this will empty out. The ground zero is now for the end of October, if this rate is replicated for the next 2 months, and I believe it will be. But if it's October, November, or even September, it doesn't really make much of a difference. We're still within months of the final Keynesian style recession, depression, crash, whatever you want to call it. It's a slowdown or it's a catastrophe. It's going to be what it is. Now, once we run out of the reverse repos, what happens is this. In the blue, we have the amount of bank reserves in the banking system as a percentage of the amount of repos, of repurchase agreements that are made every night. The repos come from reserves. I've said this before, but I want to show you where we are on this chart. We're at 66% of all of the reserves in the banking system are used by repos. You can see here that the percentage of reserves used in repos goes up as the balance sheet, the Fed's balance sheet, which is in this red here, goes down. As the balance sheet goes down, the percentage of reserves used by repos goes up. And the last apocalypse was here at 83%, when 83% of all of bank reserves were used up by repos. That's when we had a clog in the plumbing, and that is when the balance sheet had to start moving up over here on September 17th, 2019. You can see this goes in inverse direction. And you can see here in this triangle, when we had the regional bank bailout over here, when the Fed's balance sheet blipped up again during that regional bank bailout, you could see that the proportion, the ratio went down slightly during that little jerk up in QE, but it is continued to rise as the balance sheet has continued to fall. At this rate of the increase in this ratio, we got to get to 83% for there to be a crisis, probably 83%, somewhere around there. We are going to hit that level in about 6 months, but after reverse repos finally do zero out, this ratio is going to rise even faster. So if you take maybe 2 or 3 months off of that total, we have about 3 to 4 months until we have what looks to be a coming repocalypse. And that will be after the Keynesian style recession that is building up becomes absolutely obvious. And why do I think it's obvious? Well, we're going to take a look at these.
In today's news recap, silver rises on hopes of deeper U.S. Fed, rate cutting cycle expectations. Silver prices surged by 1.66%, driven by growing expectations of a deeper U.S. Federal Reserve rate cut cycle, which could start as early as this month. U.S. job openings dropped to a 3.5-year low in July, signaling a cooling labor market, further fueling speculation of an imminent rate cut. According to the CME FedWatch tool, there is a 57% chance of a 25 basis point cut and a 43% chance of a 50 basis point reduction in the upcoming Fed meeting. Additional data revealed that U.S. employers cut almost 76,000 in August 2024, the highest in 5 months, while private businesses added only 99,000 jobs, well below expectations of 145,000. These figures reinforce the view that the U.S. labor market is softening, adding momentum to rate cut speculations. India's silver imports are on track to nearly double this year, driven by demand from the solar panel and electronics industries, along with increased investor interest. India, the world's largest silver consumer, imported tons of silver in the first half of 2024, a significant jump from a year ago. This surge in imports is attributed to stockpiling by industrial buyers to guard against potential price increases. Technically, the silver market is seeing short covering, with open interest down by almost 10%. Now we'll show you the best clips of the latest interview, but first, hit the like button, smash the subscribe button, and turn on notifications so you do not miss out our daily recaps. Enjoy the episode.
Articles. So we have here from the RT, the first sign of a building Keynesian recession. U.S. job openings fall to lowest levels since 2021. Data underlines how demand for workers is slowing as Federal Reserve plans next move on interest rates this month. They will definitely cut, could be a quarter point, could be half a point. If there's a crisis before then, it'll be more. And eventually they will cut all the way back down to zero once the crisis becomes obvious to all. Now, if we move to the next one, we have planned U.S. layoffs surged in August, recruitment firm Challenger says. So we have lower job offerings, U.S. layoffs surging in August. U.S. employers in August unveiled the greatest number of layoffs in 5 months, led by cuts in the tech sector amid a cloudy outlook for growth and ongoing cost concerns. A monthly tally of workforce reduction announcements showed on Thursday. Firms announced 75,891 layoffs last month, roughly triple the number in July and the largest month-to-month increase in a year. We're headed there. The unemployment numbers are not out yet. They will be out in a few numbers, but you can see here they're already ticking up. We're at 4.3%, and the last 3 times that unemployment rate has bottomed and then started to tick up, we were already in recession. We're very, very close now. Once we hit this, we will have a plumbing problem. It will be exacerbated by the monetary dungeons, and we will have the Fed moving in spectacularly, and gold and silver will slingshot. We are within months, I'm convinced. Now back to the chart. Another reason why it looks like the Keynesian style recession, the final recession, is building steam is because Bitcoin cannot reach another high. Bitcoin feeds off of inflation, off of monetary inflation, and the monetary inflation is now stopped. And then you could tell me here, well then, if Bitcoin feeds off of monetary inflation, why did the price of Bitcoin move higher in all of 2023 until the early 2024? This is Bitcoin in terms of gold, as you can see. Why did it move higher? Well, because the reverse repos were headed into the monetary system. So even though there wasn't any direct inflation, we had sterile dollars moving into the banking system, and Bitcoin caught a lot of those dollars. And now it is headed down. The high was actually on October 18th, 2021 at 33 ounces of gold, sorry, 37 ounces of gold, 37.3 ounces of gold. We are nowhere near that now. We are at 21.81 ounces of gold and falling. So we have the low end of the economy falling, the high end of the economy falling, and Bitcoin falling all together. And what about gold? Well, gold relative to other commodities is at a major resistance level here at, what is it, 9.41. The high on May 17th is 9.42. I'm discounting this because this was during the lockdowns, which gave it an unfair boost. But you can see here, this is the final resistance. And we could see gold climb a lot faster than commodities. Obviously, during a recession, during a Keynesian-style recession, you always see commodities falling hard and gold also falling, but falling a lot less than other commodities. So even though gold and silver will be falling nominally during this final Keynesian recession, you will see this ratio climb higher and higher and higher as this happens. And then once they start printing the money again, nominally, it will slingshot to, I believe, $3,000, $4,000, $5,000. It could be by the end of this year or early next year. Whenever the next printing round starts, the climb is going to be extreme. One final sign that the Keynesian-style recession, the final one, I believe, before the last round of printing, is on the way, is that the 10-year minus 2-year curve has normalized. It is now above zero. I think it's like 0.04 or something. That means that 10-year yields are finally above 2-year yields. And when that happens, this blue line over here, when it starts to go above zero, very shortly after, you have, again, a Keynesian-style recession. I don't want to call it just a recession because it's just the revelation of the ills of monetary printing. So it's a Keynesian-style recession. We saw it in 1990, we saw it in 2001, we saw it in 2007, 2008, and we're going to see it again now. The question is, what is going on with the 10-year minus 3-month spread, the difference in yields between 10-year and 3 months? That is still below zero, meaning 3-month yields are still far above 10-year yields, and we see here a divergence in this rectangle here, and I put here what the ... Why is there a divergence when this usually goes in tandem? Well, I zoomed in over here on 2001, and this might be a precedent for the 10-year minus 3-month rate spread diverging from the 10-year minus 2-year rate spread. It diverged very temporarily, ephemerally. Even we saw the 10-year minus 3-month head down even further below zero to about -1, while the 10-year minus 2-year spread was above zero. But that quickly repaired itself, and these started going in tandem very shortly after that. So I believe that if the 10-year minus 2-year spread is heading above zero, very shortly, the 10-year minus 3-month spread will head above zero quickly, and it will skyrocket back up once the Fed starts cutting in response to a plumbing problem.
What do you think of Rafi's analysis? Is he spot on, and do you agree with him? Post in the comments section your honest opinion and share your price prediction for silver going into year's end. Share this video with a gold bug and watch this video right here because it's a perfect fit for you. I'll see you on the other side.